To build anything that truly lasts, it takes time.
But as US President Donald Trump's July 9th tariff deadline looms, global markets brace for impact, and the 90-day pause on the reciprocal tariffs excluding China ends soon, potentially increasing import costs. Now, economists are warning of increasing inflation if talks fail, and stocks have fluctuated and faltered, with the S&P 500 down 4.2% this month, a significant downturn after several months of gain. While Trump hints at flexibility, uncertainty rattles investors. How might the expiration of President Trump's tariff deadline on July 8th affect the markets, and what are the potential risks to global stock markets, particularly the S&P 500, if new tariffs are imposed after the deadline? To discuss all this and much more, let's welcome on board Mr. Arnab Das, Global Macro Strategist, EMEA at Invesco. Mr. Das, hi, and thank you so much for joining us on the show. First up, give us a sense of everything that we're seeing on the US trade deal front. We now have Canada that's rescinded its digital tax on the digital services tax on the US. You also have the deadline that's soon approaching, and Trump has also made a few comments saying that they've inked a deal with China. India is up next. What are you making of all of this in the whole scenario of the tariff deadline looming?
Well, I think President Trump is trying to move things along. I guess he still wants to try and get as many of these framework agreements and sort of heads of terms that they're calling trade deals inked by July 9th. And I think there will be some success in that. And like you say, Canada has conceded on the digital services tax, which is a positive sign for restarting those trade talks and moving towards a deal, like you said, by the 21st. But of course, Canada and Mexico are extremely dependent on U.S. economy and U.S. U.S. trade. But other countries, I think, it'll be somewhat harder to get all these deals done so quickly. So I think there is some chance that there'll be some progress in some countries, and that some countries will have to continue to negotiate after July 9th. Although it is encouraging to hear the president say that things are moving along, I'm not sure that's the whole story.
Okay, so that's the entire take coming in on what could happen if the tariff deadline comes our way and how the global markets could react. But let's also talk about the entire dollar index move that we're seeing, sir, and the kind of cool off that we've seen in the dollar index on one side. On the other side, you have the Trump tax bill that has been passed, although it's been with a very narrow margin. And economists say that this could inflate US debt by $3.3 trillion. If US ever plans to service its debt, they have very limited options but to depreciate their dollar, which could also put further pressure on the dollar index. Amid everything that's happening, how do you think the dollar index is going to fare?
Well, look, I think what's driving the dollar index down is the persistence of the trade deficit at the same time, in the context of less capital coming into the US, maybe some portfolios being rebalanced, at least to some extent, away from the US towards Europe. And it's still taking place, under very good market conditions in the US itself, right, with the S&P reaching new highs. So I think what's happening is a bit of a rotation by foreign investors out of the US, away from the US, perhaps towards Europe, perhaps towards emerging markets, which are performing relatively well and where the currencies are doing relatively well, and away from the US, while domestic investors, including retail, are buying the domestic stock market, right? So I think that explains these different moves. I don't think it's that the US government is directly and deliberately depreciating the dollar in order to make the debt more serviceable. I think there's this rotation going on because the US is going to be less inviting to trade deficits and therefore less inviting to capital inflows. The fiscal story is part of this rebalancing as well, because the U.S. appears to be going for a much larger deficit, and is continuing with the spending boom without much spending. With the tax cuts and the domestic spending boom that's associated with that, without much success in cutting public spending, as Doge had been intended, or at least aimed at doing. So that's why I think we're going to have a much larger fiscal deficit, but maybe a somewhat smaller trade deficit, and very likely somewhat smaller capital inflows into the U.S. So when you put all of that together, I think what you end up with is a continuation of the trends that we're seeing in the market at the moment, right? So one, a weaker dollar; two, higher bond yields in the US and elsewhere, because there's a fiscal stimulus taking place in other countries as well, notably in Europe, but also China, possibly also Japan, to try and deal with the demand shock of less US trade, less US imports, and higher equities as we get this propulsion of US retail, and other investors into US stock markets, and domestic investors and other foreign investors being more interested in diversifying away from the US into other stock markets. And I think that process is just beginning, because there are tens of trillions of dollars of foreign exposure in US asset markets of all kinds, which needs to be rebalanced, at least to a significant degree. So I think that's what's going on in the markets broadly, and I think it's likely to continue.
Mr. Das, if you could give us a sense of what do you think the Fed is about to do next? Because largely, if you see, more or less, their inflation seems to be near the levels where the Fed wants it to be. On one side, you have Donald Trump that's pressurizing the Fed once again, saying that interest rates should have been around 1 to 2% by now. On the other side, we have fresh comments coming in from Fed's Raphael Bostic, who says it's still too soon to swing in any direction. What would be your call on the Fed's rate trajectory going ahead?
I think in the short term, the Fed's going to wait, sit it out, wait and see, and stay on hold, as Raphael Bostic suggests, because it's worried that it hasn't seen the pass through of the tariffs that are there, into inflation, and that's still a risk. And there is a situation where some of the inflation expectations have risen, right? Survey-based inflation expectations, particularly of the public, which are obviously very important to the Fed, some of those have become elevated, even though market expectations are still very tame. So I think, if you split the difference and look at all these things, right, the story is somewhat stagflationary. It's not just about trade, substantially about trade, but it's also about immigration. Immigration, is probably slowing pretty significantly, if not reversing, right? It's probably not reversing, but it is slowing significantly, which is going to be a constraint in the labor market. It's probably going to hold up wages. It may push wages up in some sectors of the labor market higher than they would otherwise be, even if the labor market is easing a little bit and continues to ease as the economy slows down. So I think we are looking at a bit more of an easing process, but a hold in the short term while they wait to see if there's any of this inflation risk. And I have to say, if the president pressures the Fed to cut, that puts the Fed in a very difficult spot, and I would suggest the president is playing a very dangerous game there. You could see rises in bond yields and in the term premium, because the riskiness, the inflation riskiness of pushing the Fed to do what it doesn't want to do, or maybe shouldn't do, or isn't ready to do that too early, is quite a dangerous game that's been played before by Presidents Johnson and Nixon, with very bad effects on bond investors through inflation. So I think that pushed the Fed to hold rather than to follow the president's guidance on rates.
And Mr. Das, before we let you go, also want to get your sense on the US equity market. With a lot of news flow, one would imagine that all of these global triggers would be affecting the US market, but that's not been the case. You have crude that's once again, it's softened once again from the high levels that it had spiked to, and that was very short-lived, probably for only 12 days or so. The US equity markets, they continue to inch new records every day, new record highs. How sustainable do you think this is, given that July 9 is just around the corner?
Well, I think there are clearly risks because the valuations, as you say, are not cheap. They remain expensive. Valuations in other parts of the world are catching up to some extent, but remain cheaper than the US, sort of overall. Although some sectors, even in Europe, are now, relatively pricey. I think what's going on, like I said before, is that domestic investors are buying U.S. stocks. Foreign investors are maybe rebalancing away or maybe hedging their currency exposure, explaining the weakness of the dollar. And like I said before, I think this will continue. I think the US still has a lot to offer, even if the economy is slowing down. The technological revolution is mainly made in the USA, and it's probably going to continue to be made there. We'll see if they do more damage to it by restricting immigration of talented people that are essential for the tech sector and other sectors as well. I think in the end they will end up not doing that. I think also the U.S. is going to continue to deregulate the corporate sector and the financial sector, and so it's going to be a higher risk, higher return economy than, say, Europe. Europe is talking about deregulation, but it's talking really about regulatory simplification rather than full-blown deregulation. So Europe is going to be a somewhat lower risk and therefore lower return economy than the US, I think, still on a going forward basis, even though it's likely to be better performing than it has been recently. So I think that's kind of the story. And like I said before, I think it's going to continue. And I think those trends are worth, maintaining exposure to in one's portfolio.
Okay, so sounding optimistic on where the US equity market is heading. On that note, Mr. Das, we'll let you go. Thanks so much for joining us and taking the time to speak to us at ET Now today. Well,
if you like this video, then like, share and subscribe to ET Now.